Good afternoon, everyone. This is Kim Schmidt, the Executive Editor of Farm Equipment Magazine. Welcome to our latest webinar with the Western Equipment Dealers Association. Today, we're going to dig into the results of the 2019 Cost of Doing Business study. Before we get into that, a special thank you to Iron Solutions, who sponsored this year's Cost of Doing Business study, and also a thank you to all the other regional associations and dealers who participated in the study this year. Today's presenters are Curt Kleoppel, Trent Hummel, and Gord Thompson. Curt's worked with regional associations in the farm equipment and hardware industries for over 34 years and is currently the CFO for the Western Equipment Dealers Association and president of Equipment Dealer Consulting. Equipment Dealer Consulting has been a longtime partner with WEDA and provides accounting, audit, valuation, and tax services to members of the association. Trent's a fourth-generation farm equipment dealer from Alberta. In 2010, he sold the dealership and began helping other dealers through training and consulting. He designs and delivers curriculum-based training, on-site consulting services, and facilitates 20 group meetings. And finally, Gord's began his career with a national accounting firm prior to joining his family's Case IH dealership in 1986. He was the dealer principal and general manager of the two-store dealership in Saskatchewan until 2014. When they sold to Red Hat Equipment, and in 2015 he retired. Then joined WEDA's Dealer Institute as a trainer specializing in dealership financial management and training dealer staff on understanding and utilizing financial information in 2016. Before they get started with their presentation, just a few housekeeping items. On your screen there's a control panel with a Q&A icon. You can submit questions here at any time during the presentation, and time permitting, we'll try to answer as many of your questions as possible. And if for any reason your internet connection or even ours seems like it has failed, go back to the email you got telling you how to enter the webinar, and you can click on that link and get back in that way. Okay, we're ready to get started. Thanks again for joining us, and take it away, guys.
Curt, you lead off.
Go ahead and go to the next screen, and here's the participating dealer associations that help sponsor that Kim mentioned on the previous slide. And there's the 2, 4, 6, 7 associations that participated, and we're very thankful for their participation. One thing I might want to point out right now is that we did have a better participation with high volume dealers, especially in Canada. So for the Canadian study, when you get it and you look at it and you look at 2019 results to 2018, you're going to see some contrast changes between the 2 years, and a lot of that, they added participation in high volume dealers. And we also had that in with the United States dealerships for the North American averages, but when we combined that participation with the United States, it didn't have that much of a dramatic effect on the North American average, but it did in Canada. So I just wanted to point that out real quick. And again, the study is free for participating dealership, and those studies should be going out this Friday to the regional associations that participated, so they can get that out to their members that participated in the study. And if you belong to Western Equipment Dealers Association, you should be seeing an email about getting the study. And also, if you participate, you'll receive your copy probably by email. If not, just give us a call at the association. The cost of doing business history and methodology, most people know how the reports are divided up. There's 4 individual reports by regions, and it includes 2018, 2019 data. And I want to point out, when we talk about 2019, it's actually for the year ending 2018. And of course, 2018 data is for the year ending 2017. And then the North American report also includes 2019 and 2018 data. And also, we also have the dealerships breaking down by volume. And we have a low volume under 25 million, mid volume 25 to 75 million, and large volume over 75 million. Most of the things that we're going to be talking about and the differences between 2019 and 2018 are around North American averages, and it's by location. But we will be talking about these different volume category dealerships and the differences between the large volume, mid volume, and low volume, because there is some things that need to be noted that we found in the study. And then the charts and graphs always show a 5-year history, which is good. So you kind of see a big picture of what the trends have been. And, 2018 or 2019 study is looking comparable to 2015, wouldn't you guys say, on some of the percentages and sales volume?
Yes, I'd say so. It's trending that way.
Yeah. So other few things to note, again, the averages are reported on a per location basis. Dealership data is all U.S. dollars, so we can get apples to apples. And then also, again, mentioned 2019 is for year-end 2018, and 2018 is for year-end 2017. Mergers and acquisitions, it still looks like it's going fairly strong, not quite really as big of a jump from 2018 to 2019 as we had from 2017 to 2018. In fact, a little bit bigger. We went from 3.53% to 3.92%. So those items are still happening in the M&A world.
So Curt, last year when we did this, you said that the big jump was because there was more mergers going on and many dealers cashing out. Is that still the trend for right now, or what's going on right now? Is there more mergers or more cashing out?
Yeah, there's been more mergers. Last year, 2018, the items that we were involved in, we were seeing a lot more mergers. And I think the reason for that is because of the size of volume of dealerships that are getting together. It takes a lot of capital for somebody to buy somebody out. I mean, you're looking at 5, 7 to 10 stores combining with 5, 7, or 10 stores. I mean, before in 2016 and 2017, we were looking at 2 and 3 store dealerships combined with 5 and 6 store dealerships. So you saw some acquisitions in that time frame, but now with the dealerships getting larger, we're seeing a lot more mergers.
So are the stores that are 1 and 2 locations, let's say the small volume dealers, when they cash out, are they cashing out to a mid-volume size dealer, or are they cashing out to a large volume size dealer?
It depends on the region that it's happening. We've seen both, that 1 and 2 store locations are being bought by 3 to 7 store locations, and we also seen where 10 plus store locations have been buying out 1 and 2 store dealerships. So I think it kind of depends on the region that you're in, and also the dealerships that are around you that are the same brand and manufacturer that constitutes whether or not it's high volume buying out the 1 or 2 locations, or the mid volume dealer buying out the 1 or 2 locations.
And my last question on this slide, Curt, are you seeing more dealers inquiring with you about trying to cash out of their stores right now than in the past, or is it normal, or what's the pulse right now as far as wanting to cash out or stay in the business?
Oh, I think it's not quite as strong as it was in 2016 and 2017. I think it's very comparable to 2018 is comparable to 2017. You're still seeing some activity, and I guess this past week I've gotten 3 phone calls on valuation work. So I guess it might be picking up here in 2019 for the year 2019 too. So, and also 2019, we've done quite a few mergers in 2019. So I think you know, I compare it to 2018 probably. Now we're looking at the North America revenue growth, new whole goods, sales volume, and new and used, and parts and service, and then total location. And as you can see, quite a bit of a change from 2018 to 2019, 15 million in 2019 compared to almost 11 million in 2018. So a good growth in new whole goods sales and a good growth in used whole goods sales. So, and like what we'd like to see, I really like parts and service, don't you guys? I mean, that's a good step in the right direction.
It's been very nice balanced growth. I mean, and every department's growing. I just say on this slide, last year I had a complaint from or question from an individual. Why doesn't the four numbers above the $15 million add up to 15 million? Well, it's because I left off some of the other income lines or revenue lines like rental and warranty and outside labor and volume. I've left those off on this chart. The chart would be just too big, but location totals are 15 million, and last year they were 10 million or almost 11. It's significant growth year over year.
But to be clear, part of that is due to the fact that there was more large dealers in the study this year.
Yes.
Okay, asset turnover again, that has improved since 2018. As you can see, from 2017 to 2018, we had a good drop, but we've gotten that back plus some. So you look at 2019 asset turnover, it's better than what we had in 2015. And then inventory turnovers, which again, 2015 is actually 2014, because we all know used equipment started in 2015, but 2015 studies for 2014 financials. So 2014 was still a good year for the ag industry. And then you look at inventory turns, that's impressive too, 2.62 times compared to 1.91 last year. Your guys' thoughts?
You start, Trent.
Well, these are, I mean, it's just tremendous growth, but and when we added this inventory, we've got higher sales. And Gord said that the numbers on the prior slide, we had 50 million in store sales because we got more big dealers reporting, and that's right. More big dealers usually sell bigger iron all the time, and they're just managing it better, and their influence on this number is tremendous.
It's good to see. It's really good to see. I think it's a reflection of some of the challenges dealers have been facing, where they've gone through some low turns and they've gotten more disciplined.
Yeah, and again, you know, we've had higher participation of high volume dealers, but also I think at the same time, you know, we haven't talked about it yet, but the lower volume dealer is also contributing to some of this improved trends for as far as asset turnover and inventory turnover.
Some of the data that has been shared with me by dealers, they're not shooting for the industry of 3 inventory turns, hitting 4 and 4.5. I've seen a few at 5 and 6. They're really managing their inventory, but 4 and 4.5 seems to be a target that lots of guys are striving for to make businesses work.
Are you talking total whole goods or total inventory?
Total whole goods inventory.
Okay.
But I see a lot of parts guys saying, I can't do 3 turns. I need to do 4 turns. I want my inventory turning 4 times every 90 days.
Okay, and then we look at the whole goods inventory as a percentage of total assets, and new whole goods is 40% of total assets, and used inventory was 26.3. So just a slight increase in used inventory from a year ago, and you know, fairly big jump in new inventory increase. What do you guys think that the reason for the new inventory increase is because of more used inventory sold?
Go ahead, Gord.
I think a lot of it is just the price of new inventory.
So you think a lot of it's just the inflation value of the new inventory?
Yeah, just the price per unit is a big driver, I think.
Okay, so you don't think there's actually more units on a dealership lot? It's just most of it's because of the pricing.
On new, I'd say it's pricing. On used, I'd say it's units.
Yeah,
but
I would agree.
But the pricing also affects used valuations, but not as much. Yeah. Trent, what do you think?
Well, and you're both right. I mean, but in 2017, dealers are feeling pretty good, and they just liquidated all their stuff at the end of 15 and 16 and 17. So they put some orders in, and sure, some of it's the cost of iron, some of it's just more new iron. It's probably both. But the sad part of this slide is it's all great that, you know, our inventories went up, but our turns went up. So that means we didn't do as well as we thought on turns. We could have had higher turns if we'd have kept these inventories at 2018 levels. Our would have been on the prior slide would have been up at that 3.5 or so. So we let our inventories grow when we had a good chance to sell a bunch of this stuff. In 2018 being a pretty good year.
Another wrinkle to add to this is that when you look at the 3 volume categories, the $25 to $75 million dealers have 75% of their total assets are in whole goods equipment, whereas the under 25 million dealers are at 67%, and the over $75 million are at 65%. So we're seeing the middle-sized dealers have 10% more of their assets in inventory, and that is concerning. So they're at 75 compared to 66.8 for the average. So they're loading up more than the other categories.
Go ahead, Gord. This is your ballpark right here.
This is a really interesting one because of the split. Just as I just said on inventories, in terms of total equity, the average is 33, but on big dealers it's 36.7%. On the mid-size, 25 to $75 million dealers, it's 18.7%, and under 25 million, it's 32.7. So everybody's healthy except the mid category, and 18 is a pretty low number, man. That can create some uncomfortable situations because you don't have enough cash to properly manage your business. And we also, the flip side of that, we see it in, we'll come to it later, but the liabilities for that mid category dealer are a fair bit higher. They're, you know, the industry has 66 and they're at 81% of their total liabilities and equity. So they've stretched their payables and they just don't have as much equity. So that's a concerning. The number itself, 36 to 33, that doesn't particularly really matter. It's in a safe zone. But that 18%, holy smokes, that can cause some sleepless nights.
That's going to make some manufacturers nervous too. When the manufacturer starts getting this kind of data and sees that the mid-sized dealers only got under 20% equity, they're going to start clawing it in and asking what's going on and challenging dealers and so forth.
Oh, well, it just eliminates your opportunity to utilize leverage because your ability to take on debt is limited.
Well, you're vulnerable for a takeover. That's what's going to happen.
You're vulnerable in different ways.
Goods margins, they, you know, flat on new, you could say, and on used they went up, which I'm glad that everybody's making more money. But as we seen that on the prior slides, the inventories went up, and our margins on new they stayed flat, on used they went up. And I I just cry if dealers were holding out for higher margin on inventories that they should have been just letting go. And sometimes you just got to let it go. And so what the margin is, you need that cash. And we're seeing that, as Gord pointed out, in the mid-sized dealers. But overall, on the total, 5.7, 6 last year, 6% this year. That's kind of where the margins are at. If you're under 100 horsepower tractor dealer, this is probably making you cry, this slide, because you're hoping for 12 or 15% over on that total margin. But the big iron dealers, if they're getting 6 overall and keeping their inventory very clean, I mean, that means they're hitting it out of the park. So.
The one nice thing to look at this slide is the trend line, where over the last 5 years, we've had new margins way higher than the used because people kept taking hits on used, and it's not as bad. It's getting close. I like to see used higher than new, but at least we're getting closer, and it indicates that people aren't taking as many baths on used after they initially booked it and then having to readjust when they sell or auction or whatever they do. So the trend is in the right direction. Out
of the hundreds of financial statements I've looked at from dealers in the last 10 years, I have seen maybe a handful that have higher margin on used than new. And we talk about it all the time, and the industry knows it would be healthy for themselves if they would do it. But I don't know why. Dealers just don't have the nerve to do it. They can't do it. They don't know where realistic wholesale values are, so they buy the trade too much, and then they have to liquidate it 2 years later for little dollars. I don't know why we don't. Just fight the
if you're that small tractor guy and most of your sales are new and you get a decent margin on the new, that could be the case, but that'd be the exception.
Yeah. Aftermarket. Go ahead, Gord.
Well, the revenue's higher, the mix is lower. I think that's a function, again, of more big dealers being involved in the numbers, because when we look at the split between volumes on the different dealers, the aftermarket mix tends to be a little higher on the under 25 category dealer, and not as good in the 25 to 75, and a little better or not great in the over $75 million dealer. So I think it's been influenced by the amount of big dealers that are reporting. I really like the idea of it being $5 million higher than last year.
500,000.
Or pardon me, 500,000. Yes.
Especially on the next slide here, when the margin was almost a percentage point higher. So you sold more, 500,000 more, and got more money for it. Good sign.
Well, again, if we look at the split between the different volume dealers, the high volume dealers are at 31.8. The 25 to 75 are at 29, and the under 25 million are 27.8. So the big dealers have done a much better job of figuring out how to generate more parts margin, and those are really critical dollars.
So service sales are up considerably. I mean, that's tremendous, actually. And it hardly makes sense, because some of these shops have got 10 techs in them and they're charging $125 an hour. It seems like revenue should be a lot higher than $1 million on average. But I guess when you get a large number of dealers reporting that only have 4 guys in the shop, that's where you end up at, is about $1 million average. But the store mix, we're about, I mean, ideally you would get that number up to 10% plus would be the target. And if you did that at the kind of margin that this department makes, there's some serious cash going into the account.
Right. It reflects some bigger dealers reporting.
Yeah.
Having said that, the big dealers don't do any better job than any other category in terms of their mix on service. They're all right in that same range, within right around 6 to 6.5. So there's no real split on size, no advantage to size in terms of your service sales mix. Where I think they get it is on pricing and recovery.
But the margin that the big dealers are getting, Gord, is 61%, and then the mid-sized dealers is 57.5%, and the small dealers or the low volume dealers are 56%. So for so many years, for 10 or 12 years now, I've heard the industry talk about, the large dealers have never seen a downturn. We don't know if they can even survive through one. When we look at this study, they're getting higher parts margin, they're getting higher service margin. They've seemed to have figured it out. They're getting higher turns on their inventory. They're managing their balance sheet better. What's happened there?
Well, I'll take a step back though and look at whole goods margins. On the large dealers, it's 5.5%. On the mid-sized dealers, it's 8.1, and in the small dealers, it's 8 as well. So they give up 2.5 points on whole goods to move the big volumes that they do. They get part of it back on parts and service because they do a better job on parts margins, and I would say it's partly on pricing on service, but it's also their recovery. They write less time off. They do a better job probably on warranty and things like that. They have some better systems in place. When you look at the bottom line, the North American average is 16.1 on total gross margin. Big dealers are at 15.7. They drag it down. The mid-sized dealers are 17. The small dealers are 18. So they're 1.25 to 2.25 points lower total gross margin than the other two size categories. Now, as you're going to see, they're going to get it back on expenses.
There's our service margins that have pretty flat over the last 5 years, up or down a little.
Yeah.
Interest expense, and this is on the whole dealership or just whole goods?
Total interest. That's everything, but it's primarily floor plan. Actually, looking at it, depends on the size of the category. On the smaller dealers, it's more other interest, and on the large dealers, it's more floor plan. So I guess whether you have long-term debt or whatever you have, short-term debt.
Total expenses are up $450,000 per location.
This was the other one that warranted discussion because it also swings a lot between the categories. North American average, 13.9. Big dealers, 13%. Mid-sized dealers, 16.5%. Small dealers, 16.75. What that means is that the big dealers give up some margin on the front end on the sales, but they're more than getting it back on their expenses. So their expense management is superior. So whereas they were giving up 1.25 or 2.25 points on gross margin, you can see that they're getting 3.5 plus more back on expenses. So they're ending up a couple points ahead, or 1 point to 2 points ahead. I do like that. Just go back one. I do like that expenses as a percentage of revenue.
Yeah, the target, I always push for guys, the target should be 12 or under. And when I go into a dealership, this is one of the first numbers I look at. When I see a single digit as a total expenses, as a percent of sales, percent of revenue, I just know they're making a lot of money. So that's a huge one, is to try to drive that expense down all the time, get it under 12.
Easy to say, hard to do.
Yeah, you just got to work on it. It's got to be a constant. You got to work on it constantly, and every department manager's got to work on his department, figuring that out, how to get it down. It can't be a one-person job. So this is where it shows up. This is the large dealers. Yeah, they had lower gross margin, but they had lower expenses as a percent of revenue.
And again, I'd like to expand on that 2.6%. That's the average. It's 3 for big dealers, it's 1 for mid-sized dealers, and it's 2% for the small dealers. So that goes back to what we were saying about the mid-sized dealers being in a squeeze right now.
So they got lots of debt, they got no equity, and they're not making any money.
Oh, that's a cruel way to put it.
Is that how I saw? Is that what you just said, though?
Essentially. From a pricing perspective, they're trying to compete with big dealers to sell equipment, but they perhaps don't have the systems or the breadth of the operations to have expenses as much under control because they don't have as big a volume to spread it over.
But when I look at 2019 on this screen and 2015, which 2015, as Curt said, is the 2014 year, which was halfway through 2014 is the start of the big crash that happened.
Mm-hmm.
At 2.3%, that wasn't too shabby actually in 2014 when you look back at how bad it got in 2015 and 16.
I'm excited about 2.6, but the reality is it's coming from partly from small dealers and largely from big dealers, and it's not coming from mid-sized dealers.
Turn on asset.
Go ahead.
No, you knock her.
Well, it's the first time in a long time we've hit this target. It's not a super ambitious target, but from where we were, I mean, our returns were borderline terrible there for a while. So I'm really happy to see this number.
And what about where are they at on the? Have you got it broken down by low volume, mid volume, and high volume dealers?
I do. Just give me one shake here. Return on assets. There we go. Yeah, very diversified again. 8.8 for the big dealers, 2% for the mid-sized dealers, and 4.5 for the small dealers. So really, the small guys aren't doing bad. Same thing here. People start to think about reinvesting in the business when they can see some returns on equity. This I like. It's not quite at target, but it's a vast improvement. So how does it shake out when we look at it? The returns are just as varied as the other numbers we looked at. Average is 17, big dealers is 25%, mid-sized dealers are 8%, small dealers are 14%. So it's kind of 2 or 3 different worlds out there.
So the large dealers are at 25%.
Yep. Pre-tax return on equity, 25.1.
Wow. This is one that's near and dear to my heart all the time is what's your employee average? How many employees we have? And I got a sheet right here on it. Now I broke this down too. Under 25 million for the average number of employees that a store carries, and under 25 million stores carrying 21 employees, they're getting $618,000 per person. And that's everybody. That's from the CFO to the floor sweeper to the yard guy, everybody in between. I get this question, do you only count the people that generate revenue or more the core people? No, it's every person that's on payroll is included in this. So on the mid-volume dealers, they got 65 employees, 67 employees on average. They're only bringing in $555,000 per employee. And this number needs to be up closer to that $700,000-800,000. The large volume, they got 157 employees on average, and they're getting $936,000 per employee. Which, when you hit $1 million, that's a real sweet spot. $1 million a man is a real sweet spot or an employee, and it shows in these numbers that they're doing it and they're getting some returns that are out of this world, and they're managing their business well. They're not overstaffing, they're not understaffing, and they're getting lots of volume off each guy on average.
I always like to look at it in terms of, rather than as much on sales per person, I like to look at gross margin per employee, because that kind of smooths out the bumps from thin margin, high volume dealers and smaller dealers that are a little more intensive, because it's gross margin dollars that you pay the bills with. And gross margin dollar average per employee amongst all dealers, 111,000. For the large dealers, it's 146,000. For the mid-size, it's 95,000, and for the small dealers, it's 112,000.
So what's the spread between mid and large? You said 95,000 for mid, and how much for large?
146. So it's more than 50%.
Yeah. And this is the average for all the stores or all the sizes combined.
Correct.
Yeah, I just wanted to bring this up, and Kim didn't even know this was on here. The Farm Equipment did a study, and what I'm noticing, what stood out to me is the 62.5% in the middle. You know, that's the
Just point that number out, Trent.
There it is right there, 62.5% on the 20 to $50 million complexes, which the mid-volume dealers are averaging, the average size of them was 37 million. So it's right in the gut of that number.
And it really actually also includes the 50 to $80 million guys as well, pretty much.
Pretty much.
Which has a similar result.
Yep, 60%. What it's saying is that there's a centralized sales director that sits at a corporate office or a head office or a mother store, and he's trying to be the sales manager for his outlying store. So they got one sales manager for 2 or 3 or 4 locations and probably managing 7, 8, 9, 10 salesmen. And this size of dealerships, from what Gord and Curt have just presented, are faring the worst in their businesses, especially in their whole goods. So I'm looking at what's faring the worst and what's going on. I'm not sure that a centralized sales manager, you know, is it all of the problem? I don't know, but there could be something there that maybe having one sales manager for multiple locations and he spread himself too thin, he doesn't have a good time to do the job he should be doing, is not working. We're over here decentralized where they got management at store level. It seems like these larger dealers are doing a little better. It's never one definitive answer, but it just sometimes the stars line up or they don't line up, and it just presents itself as something. Gord, thoughts on that?
Well, it's apparent.
There's something there, isn't there?
Yeah.
And I've seen too many sales managers trying to manage 10 guys, and it's just, you can't keep up. And then all of a sudden you have some bad deals come through, some real bad deals, and they can't stay on top of it, and they can't get focused on the inventory that's getting aging because there's just so many deals coming at them from all these different guys, and he can't dig into them, and he doesn't have time for coaching. It's just too much work. Now, maybe if you had a used sales manager and or inventory manager and a sales manager, 2 different jobs like the car business does, maybe it'll work. I don't know what the answer is, but for whatever reason, something is going on there. And with that, Curt, is he there? Did he fall asleep? But anyways, everybody, we have our North American Dealer Conference on November 19th to 20th, Scottsdale, Arizona. It'll probably be a lot warmer there than where most of us are living. So if you're interested, just go on to that website on the bottom of the screen, and there's a whole layout or an agenda printed for everybody, or that you can see who's speaking. It's quite an interesting. Used equipment is what it's going to be about. And it's going to be mostly dealership panels. It's all going to be dealers up there this year. That's what they've gone to or decided to go to. And they're going to have dealers who've had big successes and poor successes, and large volume and small volume and middle volume dealers are going to be presenting. And thank you for joining us all. Appreciate it. And if there's any questions that come in, which we can't see, Kim will have those. And Kim, any questions? Curt or I?
We have some questions. Thank you, guys. One that just came in as you guys were wrapping up, wondering if the centralized sales manager and the mid-sized dealers aren't managing expenses well. Is that something that you have any insight on?
I'm not.
Go ahead, Trent.
No, Gord's got it.
Trent, do you think the sales manager is responsible for expenses?
Well, any manager is responsible for the expenses in his department if he's being held accountable to those expenses. If he's not,
true, but he's only covering part of the expenses, not all the expenses.
No, that's right. But he's accountable for the expenses of his department or what's allocated to him.
But,
now, there's only 5 or 6 or 10 expenses in any department that a manager is really accountable for. Your taxes are what they are. Your telephone bill is what it is, so forth. But these guys, every manager should be held accountable to the expenses that they can control.
I would guess in a lot of those cases, they don't all they're thinking about is equipment, moving equipment, new and used, and probably not focus that much on expense management. That's a fair statement.
Well, and this is what I've noticed here, and this is a terrible thing, but in the good years, nobody watches the balance sheet in this industry. And they're only watching the income statement, and they're just going, running and gunning and selling and thinking they're making money, and nobody watches the balance sheet. And then you get a year where you go from good year to bad year, and then all of a sudden the money's dried up, and you're thinking, I better manage from the balance sheet. This industry needs to start managing from the balance sheet on the good years and the bad years in order for us to survive. Because this non-balance sheet management is killing dealerships, and we can see it in this report today.
Okay, and then another question, which this is a kind of two-part question, so bear with me. How can diversity of products help income during slow times? And then the second part is product diversity more effective at bringing in money than having a good flow of parts and service along with promoting parts service via multi-level or multi-layer marketing?
First off, I think that it's okay to have some diversity. Depends what market you're in. My main store was in a city of 40,000. We had a bolt store and a battery store and a hydraulic store. So our upside on those areas wasn't that high. But I always looked at it from the perspective of, okay, how's my market share? How well am I doing selling what I'm currently offering? If I am at a aggressive market share and I'm really content with my market share and I want to grow my sales, I should look at new things to sell. If I'm not content on what share of the market I'm getting of what I'm already selling and what I'm best at, then I should probably continue to focus on what I'm best at and get that right. And in most cases, that means aftermarket as much as equipment. That's how I always judged it. I always thought there was more upside selling what I've already got than chasing new stuff, because it sounds attractive and it looks good, but it really we talk about sales managers that are going 10 different directions or have too many salespeople to deal with, and man, just add a couple extra lines on, and if you want to see those guys really start to spin.
Well, and extra lines also, people don't do enough evaluation on the line. What's it going to do for parts? What's it going to do for service? And how does accounting like it? So there's more than just sales saying, I want to sign up a short line because we can sell one or two of those things. The other departments need to have a say, because if it's a loser for three departments and the only one that might win is sales, well, then it's not going to be a line that store should take. But anytime you can grow parts and service at 60 plus gross margin and parts at 30 plus gross margin, I would focus my efforts on parts and service all day long at growing those two departments and selling more in there than worrying about taking on a short line where you're only going to sell $100,000 of it, or even sometimes only $20,000 of this extra short line that you think you're making a bunch of money on.
I know one of the questions we get asked was if we wanted to pick up another yard line or something like that, and my sales manager proposed something, and I'd say, how does that compare to selling one more major unit a year and washing out the trades? Well, about the same bottom line. And from a grief factor, oof, okay, let's go sell one more major unit.
I think both of you guys are
Go ahead.
I think both of you guys are right. I think both of you guys are right. I think it depends on your region, your competition, but I also agree with Trent on parts and sales. I mean, if you look at what margins you can get off of parts and service, I think I would put my money in towards that as a new product line that you might not get 1 or 2% margin off of the first year, plus all the extra cost goes with it to get a new product line.
It might drive your parts department nuts too.
Yeah.
A follow-up to this question. So regarding diversity of sales and overall metrics, are you seeing anything related to precision farming in the figures, be it good or bad?
Curt, that's your question.
That's my question.
Do you have any?
Go ahead.
Do you break out precision farming at all in your report?
No, we do not. So I guess that could be one of the areas that we could break out in the future, and then we could have a better answer for that question. We could go back and maybe look at some of the financial statements that actually have that breakout. That's some of the problems that we have getting more detail is we don't always get the breakdown that's necessary to get that detail. So, in the future, we're looking at online recording where the dealerships can actually go on a secure website, enter their data, and then that way we might get a lot more data and more detail, and then we can dive into even deeper items like this. So I don't know if Gord or you guys, or Trent, if you got anything out of the study to make a comment on it.
No, I don't. I only have there's only a portion of the dealers that keep track of GPS or AMS, whatever you want to call it, precision farming on a separate line item. So
yeah, and again, sometimes we get that detail and others we don't, and some of the dealerships that actually are involved in it, like you said, they don't have a detailed line item on their income statement.
And some handle it through parts, and some handle it through whole goods.
Yeah. And at least 4 or 5 times a year, I get dealers ask me, "How do you make money with precision farming?" I don't have an answer for them. It's just a common question. Kim, any more?
Yes. Next question. Why did the new inventory levels increase both in dollar and percentage of assets from a year ago?
Well, the dollars is a function of average bigger dealer. The percentage, what do you attribute that to, Trent? Is that indicating a bit of a slowdown, or?
Yeah, that's what it does. That's what it indicates now, knowing what we're at right now in 2019 at this point in time. We got too much inventory on the ground. Everybody knows that right now. And it started at the end of 2018 because nobody knew that 2019 everybody thought it was going to be a great big bang up super year. They pre-sold stuff like crazy at the end of 2018, which all showed up in 2019. Had all these trades, and all of a sudden we get bad weather. We're too wet, too dry, late crops. You got China doesn't want to buy our north. They don't want to eat anymore. It's just a big old mess 2019 worked out to be, which it wasn't supposed to.
It seems there's greater uncertainty in the market. And I always found that the worst thing for selling equipment was uncertainty. Bad news would pass and we could move on, whether it was too much rain or not enough rain or whatever it was. But if there's uncertainty onto your markets and the uncertainty continues, then people tend to defer decision making as long as that level of uncertainty exists, or some of it. So it creates a difficult situation.
I've heard now from U.S. banks and Canadian banks that they expect as many farm bankruptcies as they've seen in decades coming into the next 6 months. And the one guy whispered to me that I said, "Well, why aren't you starting them?" He says, "Well, because we want the farmer to take the crop off and put it in the bin because we don't know how to do that. So once the calves are sold in the fall run and the crop's in the bin," he says, "then we can step in and figure out how to take their land." And I think you got guys sitting on the fence right now not buying equipment because the well-heeled guys are saying, "I'm leaving my cash because that section of land might come up for sale next door to me and I'm going to buy it."
Do you guys know another question came through, what the participation rate was for the study and what % of total dealership sales is represented by the study?
We know how many dealers reported, but we don't know what percentage that is of total dealers. Is that correct, Curt?
That's correct.
So it's several hundred dealerships are in the report, but there there isn't really a number we can compare to for industry total.
Okay. All right. Next question. Oh, did you have something else?
No.
Okay. What do you guys think contributed to the inventory turns increasing?
Mr. Hummel.
Well, the increase.
Or Curt.
Well, I think the increase in sales volume is going to have an effect on that for sure. And then, don't you think that's the biggest part of it, Trent?
Yeah, and because so many large dealers reported, and as you told me here 2 weeks ago, there was a higher number of mid-level dealers that were in the report last year that sold enough that they bumped themselves up into the large volume dealers. Correct, Curt? Isn't that what you told me? So
yes, that's correct. And also, I think in the merger world, we're seeing more of the, say, better quality middle tier dealerships being merged with the higher volume dealers. And I think that's part of the reason why some of the mid-tier dealer percentages have fallen. And again, I think that's a good reason why the asset turn has improved.
And so with that, then we have the large volume group is reporting. There's more of them reporting, which actually is increasing sales because of the type of iron they buy, which is improved their turns.
Yeah, and plus they also got better control of their inventory too than what the mid-tier volume dealers had.
Yes. Yep.
Especially when you go to percentage of assets, and that's what, asset turn is based on. So the lower percentage of inventory you have on your balance sheet, you should be generating more turns unless you have no sales.
I'm looking at the numbers here now, and at the mid-sized dealers, they have about twice as much used inventory, or they had at that time, twice as much used inventory as they should have had for the volume of sales.
Yes.
But the large dealers are well under what they should have. So they've done a good job.
Yeah. If we go back to that one question, wasn't the previous question had to do how many entities were in each category?
Well, no, they just wondered what proportion of dealers report to the study compared to the total industry, I think was the question.
Oh, yeah. So, yeah. No, I was going to say I do have the number of entities by the different volume categories, but not as a percent of industry.
Next question, Kim.
All right. Sticking with inventory, but this time looking at parts inventory, what were some of the reasons parts inventory increased both in dollars and percent of assets over last year?
Well, I mean, I think Trent can talk to this, but my take on it would be that, we saw an increase in parts sales, and so that's going to drive up part of the parts inventory increase. And also, hopefully they had better asset turn on parts sales, which I think they did. And so that could drive up parts inventory too, because they see that they're making better margin and also turning it faster. So I would think that their inventory would increase.
Well, and I did some crappy math on the weekend, and the parts inventory, the increase of the parts inventory, they're turning that increase in parts inventory dollars more than 3 times a year. So the inventory that they did add, they're turning it well. It's not dead stock.
Yeah, and then also, and some of it could be price inflation too on the parts inventory, reordering it.
Some of it, yep. But it's still, as a percentage of total assets, the parts price or the parts inventory levels are not any more or any less than they were the year before.
Our next question is, have you ever considered using inventory to sales ratio as an important metric to watch?
You got a comment on that, Gord?
Well, that's what the turnover numbers are, and their inventory to cost of sales, but it's essentially driven from the same thing. So that's a really critical thought. There is a rule of thumb that says if you can keep your used inventory to under 10% of your rolling 12 new and used sales, that you will never be in trouble, and I tend to ascribe to that. So if you're talking about that, that's a good metric to use.
So now that's a great metric to use, except for the 10% is for the big iron dealers. And if you're a hay and forage dealer, you kind of keep that at 5 or 6%. And if you're a small tractor dealer under 100 horsepower, you keep that under 3. Because if you had 10% of your used inventory as a percent of new and used rolling 12 sales, and you were under 100 horsepower dealer, you'd choke on a horse. You couldn't stand it. You'd have a mistake. So it's
there's not many big dealers that are hitting that 10%. I can tell you that.
No, not this year. No.
Well, it haven't been for a few years.
Yeah.
But if you're at 20, it's a problem. If you're at 25, it's a problem. If you're 15, you're getting there. But it's a really good one. What I like about it is it gives you an answer as to what you determine what your percentage should be, and then you always compare that to your inventory in any given month, and you can see if you're above or below, and maybe it stares you in the face and says, gosh, I got $500,000 too much used inventory. I better get aggressive right now.
Here's another one for you guys. Do you have any way to know washout cycles, especially for the big equipment?
No, I don't have any way to know, but yes, I might in about 2 months, because I'm going to work on that study with you, Kim, right? I just emailed you on the week.
Yes, you did email me, and now everyone knows, so that'll hold us.
It's long overdue. But I want everybody to participate. That's how we get good data, and then we can really track this industry at how many trades do we have to take underneath a combine, underneath a 4-wheel drive, underneath a baler, underneath a high clearance sprayer, underneath a 100-horse tractor. We need to know that data. We should have known that data a long time before now, but we got to get that study up and going.
There's a growing train of thought that as equipment has gotten more expensive, there's more levels of trades than there used to be. So instead of it being 3 trades to get out of a combine, it's 4.5 or something like that.
Or 5.
Yeah.
Or 5, yeah.
Yeah.
We probably have time for one more question if anyone had one, or unless you guys had more on washout.
We don't know the answer.
Perfect timing for the marketing of it, though.
All right. Well, then, if there are no other questions, we will wrap things up for today. The presentation and audio will be available on the Farm Equipment website in case you would like to go back and review it. And keep an eye on your email in the Farm Equipment newsletter for more information on that. On behalf of Curt, Gord, and Trent, WIDA, and the Farm Equipment staff, thanks for joining us for today's webinar. When you leave, you'll be directed to a short survey. Please feel free to reach out to us and let us know your thoughts on the live event and if there's any other topics you'd like us to cover in the future. Thanks again, everyone, and enjoy the rest of your day.